Hello, this is Julius from Basic Financials. Today I'm going to do a video about trying to avoid going into the higher rate. You might hear various times that people saying that higher rate tax is voluntary. This is probably what they mean by that, because obviously it isn't voluntary, but there are ways you can do things quite legitimately, and the government are quite happy for you to do it, to try not to get into that higher rate bracket, or if you are getting into it, at least to try and minimise it. Now, I'm going to use the figures from the year to the 5th of April 2020, just because they're easier, because the higher rate starts at £50,000 worth of income in that year. Now it's gone up a bit, it's 50,270. Now, what those figures are is that your personal allowance before you pay any tax at all was 12,500. It's now 12,570, and the higher rate, the basic rate band goes from 12,500, went up to from 12,500 up to 50,000, but now it goes up to from 12,570 goes up to 50,270. So that rate, at that level of income, you're paying tax at 20% on anything over 12,500 or 12,570, and then you start paying at 40% higher rate. Now, this is if you're an employee or if you've got earnings or rental income. It's not dividend tax, but the same sort of principles apply with dividend tax. It's just you're looking at different rates. In the basic rate, you're paying at 7.5% on dividend tax. And once you get up into the higher rate, into what would be 40%, that then becomes 32.5%. So that's quite a big difference for dividend people. When I talk about dividend, there's people maybe with their own companies who are paying themselves through small dividends and the rest in small salary and the rest in dividends, and then paying corporation tax on their profits instead. But what I'm really thinking about is you're an employee, you're just starting to get a better salary, and your income is maybe going to go over £50,000, and then therefore you would start to pay tax at 40%. It's quite possible that you can reduce that if you know it's going to do that, or there's a good possibility. The obvious thing is pension contributions. If, for example, your income were going to be £55,000 and you paid £4,000 pension contributions into your own pension scheme, that £4,000 is treated as a net contribution. So it's actually, once the government have paid in the basic rate tax relief of £1,000 on your £4,000, that becomes £5,000. And that £5,000 gross contribution, you get 40% tax relief on it, not just the 20%. So the way it works, if you pay a pension contribution, the gross amount of that pension contribution increases your basic rate band. So, for example, on those figures where higher rate tax starts at 50,000, if you know your income's going to be 55,000, you could do a gross contribution to take your £5,000 to take your basic rate up to £5,000, and then by doing that £4,000 that you've paid into your pension contribution, to start with, the government add that 1,000, so it's 5,000, and then you get an extra £1,000 less tax to pay on your tax bill. So it's cost you £3,000 to get £5,000 into your pension contribution. In other words, you've had 40% tax relief on it. If you pay £10,000, it will have cost you £6,000 to get the money in. So you've had £4,000 tax relief on the 10,000 gross contribution, 2,000 at source and £2,000 by paying less tax. So it's quite a good way of doing it. Now, one thing to remember is that you do have to claim that extra tax relief. So the government won't know about it. You get the basic rate tax relief, but you have to claim it in some way. Now, whether you do that by phoning them and telling them that's what you're paying, and then they'll adjust your tax code, or you do a tax return to make sure that you fill out the information to show that what you've paid. I would personally recommend a tax return, because I think everyone's going to need to be doing something like that in a few years anyway. So with making tax digital, so that's probably a good idea to get started. And also you can keep it nice and flexible and not keep phoning up HMRC every time, which takes about half an hour at least. Now the other thing is, say you don't want to pay pension contributions, or you do, but you've got other things. You might be paying gift aid, donations to charity. Now, I'm not necessarily saying do it just for this, because obviously you've got to pay the money out. But if you're already paying donations, then you might as well get the best out of them. And again, with donations, gift aid donations, you get the basic rate tax relief at source, just like a pension fund. But you have to claim the higher rate, so you can at the moment get higher rate tax relief on your donations as well. And again, that has the same effect. The gross contribution increases your basic rate band. So an excellent way of doing it. If you're already paying, make sure you're using it. Now another little thing to add, I have talked about these things in other videos, but not necessarily specifically in these circumstances, just trying to give a good example of when they can be used, is let's say you've got a child just arrived and you started to claim child benefit, as well as higher rate tax kicking in at £50,000, or it did, very close to that now. Then another thing is you start to pay back your child benefit if you're getting child benefit. And I would always recommend claiming it, or one of you claiming it, because it just makes sure that you're in the system, and later on you'll get credited for state pension when you might not otherwise. Well, earlier on as well, because they need to know that you've got a child to be able to give you the credit if you're not actually earning enough. So definitely claim it. You can elect not to receive it, but again, you might not know what your circumstances are, so you might as well receive it and then pay it back. But do bear in mind you have to pay it back. What happens is if your income is £60,000, then by that point you will have repaid all of your child benefit. So if you receive £1,000 child benefit in the year, I know it's not exactly that, but let's say it's about that for one child. By the time you get to from £50,000 to £60,000, you pay it all back. So it's 10% for every £1,000 over £50,000. So that's another tax effectively, which you could actually again reduce by paying pension contributions, because that £50,000 limit that they look at to see whether you pay back is after taking off your gross pension contributions. So that's another good reason. So you get effectively you're getting even better than 40% tax relief on your pension contributions. Imagine if you've got 3 or 4 or 5 children, and you've got child benefit for all of them. You could be getting sort of £3,000 child benefit, and paying a pension contribution of £10,000 on an income of 60. Or sorry, paying actually £8,000 on an income of 60, and that will save you another £3,000 of tax effectively. So yeah, when you think about it like that, those pension contributions make a lot of sense. I'm not advocating paying pension contributions. I'm purely saying really that there's a way of avoiding paying tax at 40%. It has to make a lot of sense really when you think about it in those numbers. I'm going to leave it at that. I hope that's helpful to you, and get in contact in the box below if you've got any questions, and please like and subscribe as usual, and I'll see you again for another video sometime. Thanks for listening.